Thank you very much. It's indeed an honor and a pleasure to be here in the middle of this August gathering. So thank you very much, all of you, for coming here in large numbers. Well, yes, of course, certainly, we are living in times of unprecedented uncertainty, high geopolitical tensions, uncertainties on account of various reasons, policy uncertainty, and at the same time, very high debt levels, government debt levels, of advanced economies, especially very high. Now, this has implications, of course, for growth, for global growth, and therefore, naturally for global demand and the growth of the emerging market economies. And at the same time, it spillovers, possibly, potentially, and so that's a risk that all emerging market economies today need to take into account on capital outflows, because these fragilities that we are witnessing have immense, potential on that account. Inflation, on the other hand, has been still elevated. Of course, it's down from the peaks that we saw in 2022. The positive thing is that commodity prices, mostly all of you are aware, including oil, are quite subdued, with the exception of course, gold and silver because of their safe haven potential. So these, of course, these again have implications for the emerging market economies. And India, on the other hand, you would have all noticed, we have bounced back, after the COVID and the implications of Ukraine-Russian supply chain implications of the Ukraine-Russian war. We have bounced back. We have been able to manage our inflation very well, from almost about 8% inflations now.
It's below target now.
It's below target now. We are at a 8-year low of 1.5%, last number that came in. And so since February now, we have been supporting growth. We have now, of course, we did a lot of tightening. We had increased our policy repo rate to 6.5%. And the role over there, of a coordinated role with the fiscal authorities, because in India, you see about 46% of our basket, the CPI basket, is food.
Right.
Where demand, more than demand, the supply side pressures are more. And so it becomes very important for us, for the fiscal authorities to intervene. So government has, institutionalized a mechanism over there at the ministerial level to look into these aspects and identify the pressures, the price pressures, and take proactively action on the supply side, while the monetary policy, monetary authorities, they take action, on the monetary policy. So that helped us reduce inflation to within the target band. Growth again, has been phenomenal. We are the largest, highest growing, amongst the major economies.
Yeah, we have growth at 6.6% for this year.
6.8% is our projection, and on an average, last 4 years, we have got an 8+% growth rate. The first quarter was 7.8%. So I would say, a coordinated effort with the fiscal authorities, identifying, what the pressure points are, both on the demand side and supply side. And this coordinated action really helped us. What has also helped is the fiscal rectitude, which the central government and the state governments have observed. Fiscal deficit now is at a very manageable level, brought it down. It's projected now, budgeted to be down, to 4.4% of GDP for the central government. And it's the total debt of the governments, both state and central, together is amongst the lowest, amongst the the large 10 economies. I think it's only Germany which has lower public debt levels. So fiscal consolidation and good coordination between monetary and fiscal policy, that has helped us.
Well, that's a key takeaway for us. So in the
think
context
so.
of
I think
uncertainty,
so.
greater coordination
Yes.
between fiscal authorities and the
Yes.
central bank has helped
Yes.
lower inflation. Now, one issue also in this context, Governor, has been that emerging market currencies have been quite volatile against the US dollar. What's been India's experience with the rupee and, in the context of the broader EM landscape, and how have you managed in exchange rate volatility?
See, ultimately, I think, it's the macroeconomic fundamentals of any country, which are going to determine what the level, the price, the band of the economy is. Well, yes, you see, from the peak, dollar has depreciated, by about 10% this year. And now it is, moving range bound. The Indian rupee has, on the other hand, it's not appreciated as much vis-a-vis, the dollar, whereas most of the other currencies this year post Liberation Day, they have appreciated. Now, this is on account of one, we have higher tariffs. That's 50%, is the largest tariffs that we have. And on the other hand, there have been, capital outflows as well. This is also to be seen in the context of the outperformance of both the Indian rupee and the Indian equities prior to Liberation Day, say since till 2024. The Indian equities and the Indian rupee actually outperformed others. So in a way, in some sense, it's also a correction. But insofar as volatility is concerned, without going into levels, we in the Reserve Bank, we do not, as I mentioned earlier, we do not, our stated policy is not to target any price level or any price band, and let, the markets actually in India are quite deep, quite wide, and we have a very robust and mature market. So believe in, the markets to decide, what the level should be. We do, our effort really is to ensure that there is an orderly movement of the rupee, both sides, and any undue or any abnormal volatility is curbed. As I mentioned, levels are going to be decided, by the macroeconomic fundamentals, the capital flows, more importantly, the current account flows, and so what it means now with more and more countries, becoming inward-looking, global growth, being kind of subdued, still much below, the pre-pandemic levels. What it means for all of us is that we look structurally as to how we improve our own competitiveness, our productivity, so that we are not only able to expand exports, we are able to diversify exports, and we are able to get some good durable capital inflows. That's what is going to decide how the rupee or the local currency is going to actually behave. Indian macroeconomic fundamentals are very strong.
Pretty strong, yeah.
As those who are following India would be knowing, on the current account we have a deficit of only about 1% on an average. Last year it was only about 0.6% or so of GDP, and we had a twin balance sheet problem, as some of you would be aware. Both the corporates and the banks. And now, in fact, both of them are
very healthy, right?
They are very healthy. Corporates, as well as corporates, are flushed with funds, waiting, for investment. Some of green shoots, we see over there.
You see that will translate into higher private investment. I mean, that's been one kind of weak spot in the Indian economy, right? The private investment hasn't really picked up at the speed at which you would want it to. So
there are good indicators now, going forward. Capacity utilizations are increasing. There is better investment sentiment in the businesses. There is still, that uncertainty, as we are all aware, which is kind of holding back on the animal spirits. And households as well as businesses, they are kind of delaying their investment and expenditures. But there are green shoots, it's sector-wise. So some of the sectors, we are seeing some signs of investments. And so it's, we are all
so
over here.
So you do see upside risks to growth once if the tariff issue is resolved?
Yes, we have, in our projections actually taken into account the higher tariffs as the baseline.
Right.
But negotiations, are on. Even in, today there is a team over here. So I met the team in the morning over breakfast. They're over here, discussing with the U.S. authorities. See, India is mostly a domestic-driven economy.
Right.
So while we are impacted, by the higher tariffs, it's not a matter of huge concern. 6.8%, of course, much below our aspirational levels of growth, Viksit Bharat 2047. So it does impact, but yes, there will be an upside if we are able to have an early resolution to the tariffs.
Governor, I had one question specific to India. You are reviewing your monetary policy framework as we speak, right?
Yeah.
So what lessons can we learn from India's own experience and the experience of other EMs which have had inflation targeting framework for some time? So what kind of lessons can we learn from that? Or is it too early to talk about that?
No, yeah. So we are amongst the later adopters of inflation targeting. Of course, started in New Zealand. So in 2016, there was an amendment to our act, to the RBI Act, which provided for this framework of flexible inflation targeting. We call it flexible because our target that is given to us by the government, while the framework is decided by the parliament, the target is given by the government. There is an MPC, which has Monetary Policy Committee, which has internal members, 3 of us, including me, from the RBI.
And your target is quite broad.
And the target is 4% plus minus 2%,
yeah.
Which the monetary policy, tries to achieve through the policy repo rate, which it sets, and the RBI, then operationalizes the various tools that it has in its toolkit to manage that inflation. As I mentioned, it has served us well. These 9-10 years that we have now had flexible inflation targeting. It's now subject to more public scrutiny first of all, and so that makes it more credible, more transparent, and provides that legitimacy. We have a very clear communication policy. The governor reads out a statement, a long statement, giving its assessment and a rationale. There's a presser, immediately after that, and the outcomes have been good.
Okay.
Post FIT, inflation has been lower.
Right.
Of course, it's not only monetary policy, as I mentioned even earlier. It's been good coordination with fiscal authorities. But inflation on an average has come down by about 2%, which is not less, 4.9%, which is well within our band from 6.8% pre-FIT. So outcomes have been good. You asked about the lessons. One lesson, of course, as I mentioned earlier, is that economies where supply side also has to be managed, the fiscal coordination is very important. The other important lesson for us has been the flexibility that we have in this framework. So transitory and temporary kind of inflation, we are able to look through post-COVID, especially. The inflation had gone very high, and growth was also, at the same time, not picking up. In COVID, during COVID, we were in all of us were in recession. And so that was, policy rates had been reduced, inflation was very high, but still, the Monetary Policy Committee was able to look through that high inflation of about 6.6%. Our band is still the upper limit is only 6%. So this flexibility, I think, is very important when one is talking about inflation targeting.
Thank you very much.